because I think a lot of this business and a lot of every business and a lot of life is just all mindset based. And so I went down that personal development path and have never looked back. So
hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, our sponsor for the show today is Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, and they were recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through their investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. Look, there's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, I'm excited to have Tim Bratz. Tim, how are you doing today?
Todd, excited to be here, man. Thanks for having me.
Awesome. Well, thanks for joining us and excited to get to it. So Tim is the CEO and founder of Legacy Wealth Holdings, a real estate investment company that acquires and transforms distressed commercial and apartment buildings into high performance investment assets. And Tim began his real estate career in 2007, brokering commercial leases in New York City real estate market. And now Tim currently owns, I think you said about 3,500 rentals across 6 or 7 states. I believe you mentioned.
I think we're up to 8 or 9 states now.
8 or 9 states, man. I lost count after you mentioned them. So, you got a lot more on your background, but I'm going to let you explain that so you can talk about what you think is important for our listeners to know. So why don't you do that? Give our listeners a little bit more about your background and then about what you're doing today.
Yeah, I appreciate it. And thank you again for having me. And thanks for all the value that you put out there. You're making a big impact on a lot of people's lives. So, I mean, high level on me, I think, the most recurring question that I get is how'd you get started in real estate? And then how'd you get started in apartment buildings? Right now, I focus exclusively on buying apartment buildings, typically 100 plus units in, landlord-friendly states, kind of like the Southeast, the South, the Midwest, and we buy value-add type stuff. So just like I come from the residential world, and I always look for the worst house in the best block, right? And that's how you create value there. And I do the exact same thing with apartments. So I look for the most beat up building in the best neighborhood, like an A or B class kind of workforce type housing. And so that's all I focus on now. But again, I come from residential, and when the market was going crazy back in 03 to 07, I was going through college, and people said, if you want to make money, get involved in real estate. And that's what motivated me back then. So my brother was living out in New York City. He said, hey man, come and live with me after school. And I went and moved in with him. And I thought, you got involved in real estate by becoming a real estate agent. And so I go get my license and I go and work. I park it with a commercial real estate firm, and they would brokered a lot of leases, a lot of retail leases, a lot of office leases. And I just represented either landlords who were trying to market some vacant space, or I'd represent some business owner that was trying to open up a location or a second location or a 10th location. And it took me about probably like 8 or 9 months to close my first deal. And it was a small 400 square foot space in Greenwich Village in Manhattan. And the real estate there is just insane. And this is 07, 08 that I was doing this. And we took this 400 square foot space and we leased it for $10,000 a month with a 4% annual increase and on a 12-year lease term. And I'm thinking, what the heck? Like, I'm on the wrong side of the coin. I need to be owning real estate, not brokering it. Wow. Right. And so I couldn't afford anything. And I like New York, but for me, it's just a better place to visit. I wanted more lifestyle type feeling. And so I heard good things about Charleston, South Carolina. Didn't know anybody there, just moved down to Charleston. And in summer of 2008, and decided I want to get involved in real estate as an investor. And so I bought all the courses and attended some seminars and just was reading online. And just realized that I wasn't going to learn how to swim by reading about swimming in a book. I needed to actually jump in the water and actually do it, and that's what I need to do. I need to go buy a property. And I found the cheapest house on the MLS. And I didn't have any money. So I'm a punk 23-year-old kid, right? Nobody's going to give me money. Never done a deal before. And then the housing market crashed, like the worst market ever. Like nobody's going to give me any money. So I think a lot of people tell themselves like, oh, I don't have money, so I can't go invest in real estate. And then it just shuts off their brain. And when I think when you make a statement like that, it doesn't get the creative juices flowing in your brain. If you ask yourself a question, it automatically leads to an answer or another question. So I asked myself, I said, hey, how can I get the money if I don't have the experience, if it's a worse real estate market and I'm a young kid and I've never done this before. And I said, hey, it might not come from friends and family. I'm not going to be able to get it from some private money lender, but I have this credit card, and I had this credit card with about $3,000 on the limit. And I heard you can call them up and actually increase your limit. So I called my credit card company. I said, hey, I'm about to make a big purchase. Will you increase my limit? And I asked for $100,000. They laughed at me, but they gave me 15, So that's one of those, that's another lesson, like aim high aim high and miss high, right? You're still okay. And so that's what I ended up doing. I got some balance transfer checks. I wrote myself a check for 15 grand and went and renovated this house personally. And I YouTube, I don't know how to do it. So I just YouTubed how to change out carpet. I YouTubed how to change out light fixtures. I YouTube,
Wow.
I'm reading the directions on this stuff. I don't know if anybody's ever done that, but that's how I learned. And so I physically did all the work. And then I said, how do you sell a house? And I Google searched that. And it's like, hold an open house. So I was like, all right. So I put out some signs. I passed out some flyers. And one of the neighbors came in and bought the house for $33,000. So I was all in for around 19, maybe 20. So I made about $14,000 on my first deal and, spent about 120 days. And I was like, I don't even know what the heck I'm doing. I'm making money doing this. Like, let's go do it again. So do it again. Got into wholesaling. And I think a lot of us get into real estate because we want to be the landlord, right? We want to have residual income. We want passive income. We want to build that long-term wealth. But then we get stuck in this transactional hamster wheel of trading our time for money and going out and doing a deal and getting paid and then having to do it again and again and again. And it's thinking that we have to stockpile our own cash. And that's kind of where my mind was, at least. And so I went out and got into wholesaling and I started flipping houses again, or I was doing more house flips. And eventually what happened though is I met people who had money, who were either buying properties from me or saw what I was doing and wanted to get involved, but maybe they didn't have the bandwidth like to take on deals, or they already had at max capacity on the rehabs they were doing, but they still had money, or they had money and they just didn't know what to do in real estate and they had money from some other business. And they ended up saying, hey, why don't you do the work? I'll bring the money and let's figure out a split somehow. And that's how I got my first private money lenders. And I bought a package of 5 houses with $100,000. Like, again, this is 2010-ish, whatever. Like when the market was at its bottom. And I found some houses in the hood and I bought 5 houses for $100,000 and fixed them all up, refinanced the guy out within 12 months and gave him all of his money back, a massive return. I think he made 25-30% on his money inside 12 months. And but then I got to keep the properties. So I'm all into these things for about $130,000 after I paid him off. And they were cash flowing like crazy. They were renting for $700 a month and there were 5 of them. So that's $3,500 a month for all in for $100,000. And so I ended up building up a portfolio of about 10 houses. I was essentially financially free. I wasn't rich, but after all operating expenses and debt service and everything, I had about $3,000 of passive income coming in. My lifestyle was, I don't know, $1,500 to $2,000 a month. And so I was financially free, right? So like I'm feeling good. And then I shiny object syndrome, right? You go and chase some other industry. And I got out of real estate and drank the juice so much that I ended up selling my real estate and thinking this other business would take off, and it just didn't. And 2.5 years later, I was just completely broke, right? I had $25,000 in credit card debt. I was paying for gas with coins out of the cup holder of my car. I'd travel for business and sleep in the back seat of my car and go and, shave in the hotel parking, or the hotel lobby bathroom, in the morning, and just, it was bad. Like I was intermittent fasting before it was cool to intermittent fast, like just not eating all day, like getting a sandwich for lunch, a foot long sub, eating half for lunch, half for dinner, and that was it. And so, man, that was my life in summer of 2012, and I thought I got to get out of this. What do I know? The only thing that what worked for me was real estate. So let me go back to real estate, and I left that business, and a couple of guys who I met through that business reached out to me and said, "Hey, we got some cash. We want to invest in real estate. And, can we go play some Monopoly together?" And I had kind of an exclusive relationship with those guys. Went out, turned a little over $1 million into about $4 million worth of property over the course of 3 years. And that partnership ended up fizzling out, and we ended up liquidating everything in 2015, 2016. And I've just been doing my own thing ever since. And so, um, been, man, punched in the face, knocked down, everything you can possibly imagine. Had buildings burned down, had tenants, burn me, had contractors burn me, been, sued for stupid stuff that I didn't even do anything wrong, and had to settle, and like all sorts of different things. Um, and so I've run the gamut. I've tried vacation rentals, wholesaling, turnkey real estate, high-end flips, low-end flips, single-family rentals, office buildings, vacant land, private lending, property management division. Like I've done it all. And I sat back about almost 3 years ago now, and just looked at my entire portfolio of like, where was I building my wealth and where was I spending my time? And 90% of it came from apartments, and it was only 10% of my time. And I thought, get rid of everything else, focus, and what you focus on expands. Took me from a couple hundred units to, several thousand units in a span of about 3 years.
So let's talk about that and that expansion then. First, before we get to that, I got a question. You had this business that didn't succeed, right? And but out of that, you said you got several people that want to give you money to work that money.
Mm-hmm.
Explain that to me, because you would think if they watched a business not succeed, you had to close the doors on that. They would be hesitant to just giving you money. So how are you able to build that trust with them?
Yeah, so it was a different kind of, it was like a network marketing kind of business.
Gotcha.
And so the failure rate in that is pretty significant.
Yeah.
And I was actually in the top 1% of producers. It just didn't make any money, right?
Yeah.
It was a type of network marketing company that you got paid for recruiting people. And I didn't like going out and like recruiting people that I knew wouldn't do the business and essentially take $500 of their money, right? And I was just like, this doesn't sit well with me. I wasn't making a lot of money. I was spending a lot of time and spending a lot of money going to all these events and everything, and was totally broke, putting 30,000 miles a year on my car, going to all these home meetings and stuff. And philosophically, it made a lot of sense. It wasn't a good business for me to be in. I had other skill sets, but I met some phenomenal people. I went through some amazing personal development, learned how to public speak out of it, all this different stuff. And it's really set me up for a lot of good things moving forward. So, did I learn a lot? I learned a ton. Do I wish I didn't do it? No, not necessarily, because I learned so much, and it opened up a lot of other doors, and it got me to where I am today, right? Maybe I wish I didn't spend 2.5 years of my life on it, but it was good. It was good while I was doing it until it was time to just move on. And so what happened was two of the senior vice presidents, like the guys at the top of the pyramid kind of a thing, were making a lot of money. They were making $1 million plus per year, and they had a bunch of cash saved up, and they got into that so that way they could have cash to go and invest in real estate. And I was in the top 1% of everybody on their team, and I had a good relationship with them. And when they heard that I was leaving, they didn't really get mad at me. They just said, "Hey, how about we find another way to make money together? And how about we invest with you?" And so that's what we ended up moving forward on.
Got it. Yeah. And actually, network marketing, I mean, whether it's profitable or not, that's for another conversation. But um, the training that you get is with most network marketing companies is actually really good. I
They
did
have
a
to.
little bit of network marketing, and it was excellent training. A lot of mindset training,
Mhm.
a lot of business training. I thought it was excellent.
It really grew me from a mindset and personal development and entrepreneurial outlook
Yeah.
perspective. I gained a lot of good skills on, again, public speaking and um, like sales and marketing and strategy and again all that mindset stuff. And some of these companies, they don't make a lot of money, so they have to like provide value in another way, and that's really through the education, the personal
Yeah.
development type stuff, and that's what keeps people around. And that's really what hooked me, because I got hooked on personal development, and I'm a big believer in mindset and being a Jedi mind trick ninja kind of thing, right? And just focusing on that kind of stuff. Um, because I think a lot of this business, and a lot of every business, and a lot of life is just all mindset based. And so I went down that personal development path and have never looked back. So I'm very appreciative in that regard.
Well, and I got you into intermittent fasting, which is great as well.
Exactly. Trendsetter.
Yeah. So let's talk about then the business, and then where you're heading, where you've headed now. You're into the multifamily. You've kind of phased out a lot of these other things, the flipping, the wholesaling, all this other stuff. It sounds like I don't know if, are you doing any of it, or is it completely gone?
We come across a lot of deals that don't meet our buying criteria. They're just either too small or in an area where we don't really have a team set up or anything like that. And so I have a pretty heavy social media following, and there's a lot of people who want to learn about buying apartment buildings, and
Yeah.
I do a little bit of the education stuff. So I have like this internal buyers network that I just kind of refer out deals, and
Yeah.
if they buy it, great, they'll kick me a point or two of just kind of as a thank you. But other than that, like, we don't formally go out and do anything other than just buying and holding apartment buildings.
Yeah.
And we buy and hold. We're not buying flip. We're not buying and sell. We're not planning an exit in the next 3 to 5 years. We're planning on buying, renovating, refinancing. That pays back our investors their money, takes their money off the table, and then we're planning on holding long term. The way that wealth is built is by buying assets and getting other people to pay for it, letting it appreciate, letting principal get paid down, and over the course of time, you build up so much equity. That is how wealth is built.
So take me through that strategy, because the traditional strategy is, right, we're going to buy it, we're going to renovate it, we're going to add our value, sell it in 3 to 7 years. Our investors get their money back, and then we rinse and repeat. But you're different. You're not doing that. And off camera, you were telling us also about, or telling me about, kind of how you're getting these deals. So let's dive into that strategy and how it works, because you've got to be able to pay your investors back.
Yeah, at the end of the day, if you're flipping apartment buildings, you're not building wealth. You just have a high paying job.
Right.
I got into this to build wealth, and when I've studied wealth my entire life, or at least my entire adult life, and what I've realized is that the ultra high net worth people, and the wealthiest 1% of people in the world, they focus on net worth, not necessarily on what is my income this year, right? And so if you're flipping buildings, you might have a big income, but you're not building wealth. And so I focus heavily on my net worth, and that's from buying and holding property and letting time be on your side, and finding assets that other people are willing to pay for. You create enough value that they're willing to pay you for that asset. A tenant, i.e., safe, clean, functional housing. Tenant pays you, covers all your operating expenses, covers all your debt service, and puts cash flow in your pocket. Then eventually, over time, 20 years from now, you own it free and clear, and you have monster cash flow and monster amounts of equity in the deal. That's how you build real wealth. And so that's always been my long-term play. And I see a lot of people who are like, well, what should I do? How should I jump in? How should I, should I tiptoe? I have this other business. And it's like life is short, right? I'm 34, but I talk to people who are older than me, who are wiser than me, who've been around the block a few more times than me. And they're like, listen, like do not waste your time on stuff that you don't want to do. Right. And so for me, the transactional stuff might, get exciting because I make a big pop here or there. But at the end of the day, if it just doesn't meet my long-term goal, why the heck am I spending any time on it? Like, just eliminate it. And what you'll find is, like, you grow so much more. Again, what you focus on expands. And if you just focus on that, it's amazing how the universe kind of just responds and brings you other opportunities. When you draw a line in the sand and say, this is all that I'm doing, that's all that then ends up appearing in front of you. And so, my model is just, it's comes from the residential realm though. It never made sense to me to go buy a building and pay $10 million for a $10 million building and then hope and speculate that it appreciates over time over the next 5 years. I got started in real estate when the market was falling apart, and all these people were who were worth tens of millions of dollars on paper then ended up going bankrupt. I'm like, how the heck is that possible? Well, they bought at a retail price today. They hoped tomorrow it would go up in value. And when it didn't, they didn't have the cash flow. So a couple lessons there. One, don't pay retail. Always buy at a wholesale price. Two, never speculate on appreciation. Create appreciation by value add and sweat equity. Number three, do not buy anything that's not performing or doesn't have some sort of cash flow play to it. If you have enough cash flow, you can ride out any sort of storm. So even cash flow is almost like the lowest common denominator of can you do a deal or not. If you can let it cash flow, then guess what? You're going to be able to sell it and make a big chunk of change. If it cash flows, you're going to be able to refinance it and pull some money off the table. Yeah. You can have multiple creative exit strategies on this property if it at least cash flows. And worst case scenario, if it at least cash flows and the whole market crumbles, you can at least ride out the storm, let the tenants continue to pay down principal. Eventually the property will appreciate, right? And at least you can cover all your operating expenses, you can cover your mortgage payment and put some cash in your pocket. And so that's been the cornerstone of my investing philosophy is pay wholesale, only buy for cash flow and create appreciation, never speculate on it. And so that's what my model is. So I buy an apartment building that's worth 10 million bucks. I need to be all into it for 65% of that after repair value. So I need to be all in for $6.5 million. If it cost me $1 million bucks to renovate it, my maximum allowable offer to buy that would be $5.5 million bucks. You know, I just back into the numbers. And what that allows me to do is create so much appreciation in a pretty short period of time, 6 to 18 months usually. And then I can turn around and refinance somewhere between 12 to 24 months at 70% LTV. If I'm all in at 65% of the stabilized value, and I get a 70% loan, that allows me to take a new loan off the table, pay off the acquisition or bridge financing, pay back all my investors for their down payment money that I used, and maybe even there's some refi proceeds that I can actually put in my pocket and carve up amongst the different partners. And then we put long-term fixed interest rate, non-recourse debt in place, and we hang on to it. And then we just pay down principal and let it appreciate.
And when you're saying the after repair value, that's not today's value. That's the value you're going to create with increasing the NOI and all that kind of stuff, right?
Correct.
Yeah. Hey, let's take a minute to thank our sponsor, Pine Financial Group. Look, you work hard for your money. Is your money working hard for you? Because of inflation, money sitting idle erodes your wealth. Many investors understand that real estate is a great investment, but may not want the effort or the risk that comes with owning their own property. They want to sit back and have payments, hit their bank account each and every month. Stop eroding your wealth and start building it by asking your money to work for you. You should be earning profits while you sleep, an investment backed by real estate. Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, was recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through the investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. There's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. It's www.pineinvestments.com. So in that refinance event, let's call it 24 months down the road, that refinance event that happens, are you then keeping your investors into the deal? Are you changing the equity splits? How do you treat that with your investors?
Yeah, mine's a little bit different than traditional syndication. First of all, I never knew about traditional syndication. I never knew, I never been to a course, never read a book on it. I didn't even know. And I don't really like traditional syndication in the world of like, or from the standpoint of it's not congruent, the vision and the goals of the investor and the operator, of the passive lender and the operator, because the operator is getting all these fees and asset management fees and acquisition fees and capital events fees and I don't know, fund management fees, whatever the fees are. They're taking all these fees, regardless of the property's performance. And the investors are only getting paid if the property performs, right? So it makes sense if you're going to buy something stabilized that's already cash flowing. You can take your fees and the investor's making their money, and now it makes sense. If you're doing a value add play, it doesn't make a lot of sense, at least not in my eyes. Um, and the other issue is if you're doing a value add play, all the work falls on the operator. And it's not fair to the operator that they're doing all the work, creating all the value, and only getting 25% ownership in this property long term, right? So I never liked that. And the other thing is, if you're buying something stabilized, why would the seller be motivated? If it's already renovated, if it's already in good shape, if it's already cash flowing, they're going to sell you that building for $10 million if it's worth $10 million. They're not going to take a discount on it. So that's a couple of the reasons why traditional syndication doesn't sit well with me in my model. What I look for is distressed assets, motivated sellers, just like I did in residential. And then we go in and we create appreciation. But we can turn around and do it in, let's say, 12 to 24 months. Let's say 18 months on average is our typical turnaround time to renovate it, restabilize it, and then refinance it. So it allows us to then pay back our investors, but I pay them a pref regardless of the property's performance. So they make a certain percentage on their money, whether it's performing or not. And I just build that into the cost of the deal if it's not performing and doesn't cover the cash flow. So I just create an interest reserve. So then they're seeing money, they feel good about it, they have a predictable return on their investment, which is a big deal for investors. And then two, there's more velocity on their money. So when I cash them out, I could probably just pay them 10, 12% and give them all their money back and they'd be fine. But I give them equity. They make on average about 20% ownership that they maintain in perpetuity in the project, even after the
whole
payback
of investors.
Yes. The chunk of investors keeps, let's say, 20, 25% ownership in that deal forever. So that leaves enough room for me for sponsoring the loan, for me for raising the money, for a local joint venture partner who actually found the deal and is overseeing the project management. It's going to be boots on the ground for the next 15 years of this project. They need to be compensated. Like the investor's money was only involved for 18 months, right? This person's going to work for the next 10 years, maybe 2 decades. And they need to be compensated fairly and equitably from that. And so it actually makes more sense for everybody involved because the investors, hey, I'm only getting 25%. I can get 75% of this deal over here. Well, your money also has to be involved in for 5 years. I can get you in 3 deals over here, and you can have 25, 25, 25. You have the same 75%. But then, guess what? We're holding these 3 deals, and you have all your money off the table. In deals, traditional syndication, you got to sell that in order to get your money back. You're not building real wealth.
And you're paying taxes.
Right? And so it makes, and I don't fee these deals either. Like for 4 years, man, I never took an acquisition fee. I just started taking acquisition fees on about probably less than half of our deals. We take a small acquisition fee on, just because our overhead is pretty significant now. We got to make sure we cover that. It's been stressful with a lot more money going out over the first few years than coming in, but now it's coming in, we're refinancing all this stuff, but we don't want to ever be in that position again. So now we take some acquisition fees. They're small and it's not on every single deal. And, but what that does is it means we're in the same boat, rowing in the same direction with the investors, meaning I get paid from the refi proceeds and the cash flow once the property refinances. Otherwise I don't see any money. So I'm fully incentivized to get this thing renovated, rented, and refinanced, and the investor their money back, because that's also when I get paid. So now interests are aligned and we can keep on rocking and rolling. And then guess what? They see me as a long-term partner because I'm giving them equity in a deal that we're going to own and for the next 10, 15, 20 years together. So they're like, Tim's my guy. Let me keep on rolling forward with Tim.
So I buy apartments, 100+ unit deals. I'm always looking for deals, but they're hard to find. How are you finding deals that you can get 65%? Well, it's going to be less than that, right? Because you're going to put some money into it, but 65% of future value. How are you finding those deals? What are you doing that's different than maybe everybody else?
I'm sorting through a lot of crap in order to find a couple deals. We look at 400 deals a month in order to buy 2.
Are you
that we
looking
don't.
at on market, like deals listed by brokers, or are
No,
you guys doing your own
no.
marketing?
The thing with brokers is they know who the top 10 buyers in town are. They want to earn 100% of the commission. They don't want to co-broke. So they're not taking their listings and putting them on the market. They're picking up the phone and calling the top 10 broker or top 10 buyers in town to try to sell them that deal. And that way they can earn the full commission themselves. So if you see a deal that hits the market through a broker, it's because the top 10 buyers in town all said no to it, and it's a bad deal, right? So they're going to send you a whole bunch of garbage projects that are not good to invest in, just to see, one, are you dumb enough to go out and buy that, right?
Yep.
And two, are you a serious person where you can see that it's not a good deal? And so, I again, come from the residential realm. I found off-market, direct-to-seller deals, and that's exactly what we do with apartments. And we do all the same stuff, man. Outbound phone calls, outbound driving for dollars, dialing for dollars, networking like crazy, going to real estate investors association meetings, going to landlord association meetings. We hang out at eviction court, meet all the property managers and attorneys and landlords who are angry about their tenants not paying. We want to go and buy those properties from them. We direct mail. We send out mail piece, like all the same stuff that we did on the residential side. We just do with apartments. You can buy lists. You can text message blast. You can email blast. You can ringless voicemails, all that kind of stuff. Like whatever you want to do. RVMs are getting some heat right now, so not usually the best platform, but text messaging works amazing. Direct mail still works well. Just build the relationships. The key thing to understand is this is not a get rich quick. This is a get wealthy slow. And so what you want to do is build relationships, and it's all about timing. They might not be selling today, but they might sell in 6 months. They might sell in 6 years. They might sell in 60 years. Like if you're in this to build real wealth, long-term wealth, then you're not worried about what's happening today. You're worried about building a relationship so that you're the first person they think about when they are ready to sell.
Yeah. Yeah. I mean, what you're describing there is a lot of work. Finding apartment owners is much harder than finding the owner of a single family house, because most of them have it in an LLC. And so you got to do some more legwork, but it sounds like it's been profitable for you. You've obviously accumulated 3,500 or so units. And have all the units been through your own method, or have they been through the broker relationships, or just all through
Well, I
dialing
think
for dollars?
in some markets, I am one of the top 10 buyers. Like in Georgia, I'm probably one of the top three, or I don't know, maybe one of the biggest multifamily buyers in all of Georgia. We're renovating 2,000 units there right now. We're putting 2,000 bathrooms and 2 million square feet of flooring and 10 million square feet of paint and all this stuff. So we have those broker relationships, and we moved on a lot of deals that a lot of other people couldn't qualify for, because my balance sheet's big enough and we have the experience. So a lot of other people who might have wanted to buy those buildings couldn't. And a lot of the hedge funds and REITs, it was too messed up for, and they just weren't interested. And so they want something that's just totally turnkey. And
Yep.
So I've been able to kind of create a niche, especially in Georgia and South Carolina and a little bit in Ohio as well, where I do have the broker relationships, and we do see a lot of those deals early on. That wasn't always the case. Like we still do on a regular basis. We still go through all the off-market channels to go and find off-market deals, and that's majority of how we get most of our deals. Over 50% of them come from off market, and probably, 30% of them come from on market.
Awesome. Well, let's shift a little bit and talk about some mistakes you've made along the way. What's one mistake that you can pick up and tell our listeners that you've made, and how have you learned from it?
Oh man. I've had apartment buildings burned down where I had the wrong insurance in place. I've had due diligence and the seller goes, oh yeah, no, I mean, this unit right here, it's the only one you need to walk through because it's very indicative of what all the other units look like. Oh, I trust you, Mr. Seller, right? Like buyers are liars and sellers are worse. And so I would say one of the big ones would be due diligence, and you've got to do full due diligence. Do not get lazy in due diligence. There's 100%. Financial due diligence and there's physical due diligence. And you got to go through every single lease and cross-reference it with the rent roll and make sure that The rental amount is what it says in the lease. Make sure that the security deposit that's being conveyed is exactly what it says in the lease, because that lease is a legal document that the seller or that the tenant's going to hold you to, and the court's going to hold you to when you own that property. And so, oh, well, they didn't pay rent in October, and I took their deposit and put it towards rent, so we're not going to convey that one. Do you have anything in writing from the tenant? No? All right, then I need that deposit. Like until you get something in writing where they sign off that they're not entitled to any deposit anymore. Like, no, that's transfers with the property. So like, that's a big deal. I'll give you another one. I bought the only building I ever lost money on. And here's the thing about apartments. If you buy it and it cash flows, eventually you'll break even again, right? On the valuation, even if you overpay for it. If you can hold on to it long enough, eventually it'll pay down enough principal, it'll appreciate enough in value, so you can still screw these things up pretty bad if you have time on your side. On this one, I bought a 44-unit apartment building from a guy that I knew. I had a relationship with him for a couple of years, as far as like sending him deals and talking with him and kind of helping him out with some different contractors and stuff in Cleveland. And there's got this small building, and he's like, "Hey, man, I want to dump this one and focus on some stuff in Florida or whatever." And so he's like, "Yeah, it's 80% occupied. I'll seller finance it or offer you some good terms or whatever." So I was like, "Oh, okay." And although it was seller finance, although it was 80% occupied, I'm thinking it's 80% economically occupied and 80% of tenants are paying rent. Doesn't mean that's not the case. It was only 25% economically occupied. And so on this 44-unit building that we thought we'd have to flip, turn 9 units and then turn it around, I could probably make $300,000 on it. We had to go and renovate an extra 25 apartments that were all sorts of messed up, go through eviction, pay attorney's fees, pay court fees, not collecting in rent, still paying all the operating expenses, losing money. And I ended up just stroking, like we turned the whole building. We had to in order to then be able to sell it for what we were into it for. And it was just such a headache, and it's such a morale deflator to my team that I was like, yeah, we could hang on to it and probably break even in a couple of years and then sell it. Or I can just stroke a check right now and lose like 40 grand and just call it a day, because it's going to open us up to go and do better deals and more deals. And the opportunity cost that it was taking away was worth far more than the $40,000 that for me to stroke the check. So I just wrote a check, got rid of the apartment building. And that's a due diligence piece. I looked at the rent roll and I looked at leases, but I did not verify collections. That's a big issue. Another one that's bit us multiple times, we finally learned our lesson a couple of years ago, was the plumbing. And oh man, just the plumbing always is torn up. It's always a disaster. There's always backups. And these plumbing bills are tens of thousands of dollars after we buy these buildings. And I'm like, how do we stop doing this? Well, we just have to scope the lines before we buy it during due diligence. That costs thousands of dollars. It costs us $2, $3, $4 grand every single property, and more on some of the bigger ones. And so we're just like, dude, we got to bite the bullet. It's part of it's cost of doing business, because it's going to save us. And I'll give you an example. We just did this on about 100 units in Louisiana a couple of weeks ago, and scoped the plumbing lines. Cost us like $4,000 to do it, and found out they're absolutely wrecked. We got a $72,000 price reduction because of it. So absolutely paid for itself, and we would have lost $72,000 on that.
Yep. Yeah. I mean, especially these older properties. I mean, and they don't even have to be that old. I mean, they can be, 20 years old, and they can have some issues. So
even all the way to the street.
Yeah. Yeah. When you're looking at, 1990 built property, I would be scoping the 1990 built property all the way to the street, like you just said, and making sure those lines are good. And when you're buying older properties, 1960s, 1970s, I would just assume all that galvanized, all that cast needs to be replaced.
Yep.
And so you've got a budget for that entire bill, and it's going to be on you. So if you can't make the numbers work with replacing the plumbing on those older bills, not even worth it.
I was just going to took the words right out of it. Like, people try to make the numbers work, and the easiest one for them to flex on is the construction budget. And that's not a variable cost. That is a fixed cost of how much money needs to go into the property.
Yeah.
You can't scale that back, right? No, the only variable cost is the purchase price of it. So you have to go in and buy it at a low enough basis to make the numbers work the way that you need them to work. You can't like stabilized rents are what they are. That's what the market, will bear. And so that number's not going to change that much. The operating expenses not going to change that much. So the stabilized value of the building isn't going to change that much. So now what about buying the property? So like the holding costs, yeah, you can balance that all out, but that's going to be a fixed cost. The renovation, is going to be a fixed cost. The only number that you can actually manipulate and play with and change in order to get a better deal is the actual purchase price.
Yep.
It's the only way. And if you cannot get the seller to budge on the purchase price, this is not an emotional business. It is 100% numbers based. And I promise you, as much as my net worth has grown, as much as anybody's net worth can grow by buying a whole bunch of apartment buildings, one bad deal will completely wipe you out.
Yeah, 100%. Yeah, I mean, a lot of good stuff, a lot of golden nuggets in here. What are you doing on the business side, on the scaling side, to help kind of make your business continue to grow and to scale? And what are you doing in that sense of the business?
Like grow my team? Is that what you're saying?
Yeah.
So one of the things I did, like I built up a pretty big management company in Cleveland when I was doing residential flips and stuff, and I hated having that much overhead. And so, you realize that like the number one reason businesses go out of business is because of lack of cash flow, which comes from having too much overhead, and that typically comes from having too much payroll. And so a couple of years ago, I was like, man, I have ambitions. I want to grow a big portfolio. How do I do this without actually one, I'm limited on my own time, right? And so I can only be in one place at one time. I can build up a team, but I don't want to have to manage a bunch of employees. I love doing real estate, but I hate managing people. And all of a sudden, a lot of times, people get stuck as they grow their business to just being a human resources director almost, and dealing with the drama that comes with all that stuff. And so I thought, how do I like partner with A players? How do I get A players onto my team without the overhead of having to pay them a big salary? And that way I know that they can go and take care of the project. And secondly, it's not creating this big nut that I got to cover every single month in payroll, right? And so what I ended up doing is creating kind of like a joint venture type structure where, again, I have a pretty heavy social media following. I do a little bit of coaching and stuff. Not a lot. I do 4 events a year, but there's a lot of people who want to scale into apartments who maybe they're great operators, but they don't have the time. I'm sorry, they don't have the money or like the balance sheet to sponsor those loans or bring capital. And I can bring money to those deals and I can sponsor their loans and they can be boots on the ground. And then there's other people that come out who have money, but they don't want to do any of the work. And they're like, let me just passively invest. So the education stuff and social media, if you're not active on, I mean, I know you are, but other people who are listening, they're not active. Like they should be active in telling people that you're out there doing deals because you get deal flow and money flow from that. Yeah. And so because of the deal flow, I'm not only looking for deals, I'm looking for partners. I'm looking for joint venture partners, somebody that can find the deal, oversee all the project management, and then act as boots on the ground for as long as we own this thing. And I can, instead of paying them money, I can actually just give them equity in the deal. And so for me, I don't need to have 100% of the business. I would rather have 25% of a watermelon that's this big than 100% of a grape that's this big. It's 25% of the juice in a watermelon is a lot more than 100% of the juice in a grape. And so it allows me to get into areas that I've never been to. Like I bought 105 units in Louisiana, never even been there, right? My team has. They've gone through and did all the due diligence, but I have a local good buddy who lives in that town that's going to be our boots on the ground. He's got all the local resources and everything. I brought the money, I found the deal, or my team did, and I sponsored the loan. We brought in third-party management. My team's doing all the asset management, and he's got a piece of the equity in the deal just for, kind of being an accountability partner local to the project. And so I always have somebody who's an A player local to the project to meet with the building department, to meet with insurance inspectors, to meet with or insurance adjusters, to meet with loan inspectors or anybody else that we need who needs to be like, we need somebody who's competent, who knows how to work with people, who's a complete A player. And that's allowed me to do that. So that's what I do. So like I own all these units and I actually have more equity than most traditional syndicators. But I don't own 100% of all those. Some of them I do that are up in Cleveland. Some of them I own 12 because I just, invested some cash in it or something. And then I probably average around 30 to 40% ownership across my portfolio though.
So you're probably giving away a little bit more if you were hiring an employee, but yet you're greatly mitigating your risk. You're also greatly incentivizing your employees because they're your business partners.
The only way they get paid is the property performs.
Yeah. So they're highly incentivized to perform, and you have less risk exposure because they're not employees. You don't have to pay. They only get paid if the property performs.
Yep.
So it's a win-win. It gives you probably a little bit less, like you said, equity in the deal, but probably allows you to get a lot more deals done too and get them done.
Exactly. I can do way more deals because I'm focusing on the things that we already have scaled. Like I can do asset management with a 15-minute phone call and looking at some reports each week. It's not even me, it's my COO doing it. So how many properties can he sit down and asset manage before we even need to hire somebody else to help out? So he can asset manage our entire portfolio in a half of a week by getting on phone calls and just looking at KPIs and metrics and looking at all the reports from the management companies, right? And so what do? I'm out doing marketing to get more deal flow and get more money flow. And then if I have deals, I send it off to my acquisitions guy and everybody talks to him. And then if we have money, I send it off to I have a chief investment officer who works with all of our investors now. And I send them off to him. I'm really they're the engines, to my business, acquisitions, the money, chief investment officer, and my COO. I'm the fuel that feeds those engines. And I do like the highest and best use of my time is marketing. So it's being on social media, it's being on podcasts, it's meeting new people, it's being at masterminds, it's, going to events and just, making sure that people know what we're doing and how we're doing it. And we get deal flow, we get money flow, and we get local joint venture partners from all over the country that want to JV on deals with us. And so if I have 30% ownership in a deal, but all I'm doing is I'm raising the money one time. I'm sponsoring the loan on an ongoing basis, but it's not a lot of work, right? There's a lot of scale there, just to sponsor the loan. And my team's babysitting the deal from an asset management standpoint. It allows me to get into a lot of deals and do many more. So I'm willing to take a little bit less ownership in any given deal because I can do so much more and I can scale far greater than if I had a bunch of other responsibilities.
Yep. No, it makes a lot of sense. Well, cool. So we got to wrap up. We're running short of time, but I got a couple more questions before we wrap up. What's your favorite book?
12 Pillars by Jim Rohn.
Awesome.
Easy read, man. You'll knock it out in 2 sittings and packed with just these principles, these profound principles on building an awesome life.
Cool. And then last question, what are your 3 pillars of wealth creation?
My 3 pillars of wealth creation would be earn money, save money, and invest money.
I like it. Simple. Last question. How can our listeners get in touch with you, learn more about what you got going on, talk to you about investing, all that kind of stuff?
Yeah, I'm real active on social media. One, I appreciate that, Todd. I'm active on social media. Connect with me on Facebook, and I create all my own content. I don't have marketing people that do it. I'm the one actually putting content out there. I do have a team that kind of disseminates from Facebook and puts it on all the other different mediums and stuff. But it's me. I'm answering my messages. So if you got questions, you want to talk, hit me up. I do a little bit of coaching. I'm not some guru, but I do some coaching. It's called commercialempire.com. So you can look me up on there too and connect with me there. But I put out a lot of free content. And if you're looking for insight on that stuff, I mean, this is a phenomenal podcast, and just connecting and following the people that are making moves and doing some big things. And if there's ways that I can help people, I'd love to do so. So I appreciate it, man.
Cool. Well, Tim, appreciate the time. Tons of great value you were able to add to the show, and I'm sure our listeners got a ton out of it. I know I did.
I appreciate it, buddy. Well, thank you again, man, for all the value that you're creating out there, and you keep on making an impact. Appreciate you.
Man. Have a good rest of the day.
You too.
Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.